Hey, this is Josh. Today is Thursday, July 27th. Today was a really strong bear trend day. Prices, when I came in somewhere around in here. Prices had formed, or prices had sold off strongly overnight. It was a spike in channel bear trend in this broad bear channel. The FOMC announcement yesterday was a strong bull breakout and rally turned into a final flag reversal overnight here. Um, I thought that there was a high probability of a third leg down similar to this one. We had a first leg down, second leg down comparable to the first, and so I thought a third leg comparable to these two was likely to form a large wedge bottom. This was a uh, a smaller wedge bottom with three pushes down here after a break of this tighter bear channel, but the selling pressure on the retest of this low was too strong to be considering to buy. You could consider buying here for the second entry for that wedge bottom, but at that time prices were still in this steeper bear channel. So in my opinion, and the buying pressure was not all that great. This was a small sell climax to the bear trend channel line, but personally, I did not think it was that great of a setup. But it was not necessarily an unreasonable trade to take if you're a swing trader. So, had prices flipped to always in long here. The bulls got a good bull entry bar, not good follow through. Outside bear bar, tested the low, tested these closes. You might consider buying below here as a week low 1, week low 2. Again, I don't think I think that the buying pressure was not strong enough to be looking to buy yet. So until after there's a climax or some type of strong reversal, I'm personally not looking to buy. But so I thought two legs up. I thought two legs up from this wedge bottom was likely. This was arguably a small second leg up, but the second leg up occurred over here. However, this was a bull target above this sell climax here, and you can see the bulls they tested above this bar, but could not test above this bar. But this was a week high 1 at the top of a developing trading range. Yesterday I talked about these being the worst trades you can take. So buying on a stop above this bar is one of the worst trades you can take. And I'm glad today there were some other examples as well. Like over here was a similar example. I thought there was another one, but I guess not. But so. You could consider selling below this bar as a large low 2. It's a wedge bear flag. 1, 2, 3 pushes up. Not quite back to the trend line. First bull close above the EMA in 20 bars, so the bears were likely to sell the close. You could sell below the bar for a swing down, but prices did not tick below. Instead, they ticked above on the next bar, making this a week high 1 at the top of a bear flag. So an acceptable scalp to sell with a limit order. Prices then entered this small trading range where they drifted sideways to the bear trend line. This was the first break of the larger bear trend line. This is a larger wedge bear flag and a double top bear flag. So reasonable to sell for a swing below. Here, I'll make it easier to see. To sell below this bar for a swing down. It's also a low 2 sell setup, first entry, second entry. It's a failed bull breakout of the bear flag trading range. Bears got good entry, not good follow through, but this was a breakout pullback setup. Any bulls who bought this close were likely trying to test the close. They scaled in and exited break even. So if they bought this close 705, scaled in around 10 pips lower, and then exited break even on the entire position. This was a week high 1 buy setup. It's a breakout pullback sell setup. Reasonable to sell above there with a limit order. Looking for a scalp down. Prices got the bears got a bear breakout of the trading range and a breakout to a new low. At the time, it looked like prices were evolving into a broader bear channel, but the prices could not hold, and this looked like a sell vacuum test of that trend channel line. But it's a bear breakout of the bear flag trading range with follow through, so reasonable to sell the close. It's a strong bear trend. You could also consider selling above this bar as a weak. You can consider a high 2 buy setup or a weak high 1 buy setup. It's a breakout pullback short. Selling below the bull bar on a stop, probably high enough probability, but personally, anytime I'm selling on a stop, I think that, or anytime I'm entering on a stop, I think it's better to take it for a swing. So if you sell below this bar, you're selling into the low of the day. Yes, there is room to the trend channel line, but I think it's better to sell. I mean, I'm sorry. I think it's better to take for a swing short rather than a scalp. However, if you had sold this close or above this bar, I think high enough probability for a scalp. This was a sell climax and bear trend channel overshoot. The bulls tried for a reversal from the bear trend channel overshoot. Got a small second entry buy setup above this bar. 2 bar reversal, small final flag. But the bulls could not get follow through, and instead the bears sold the close, prevented the always in flip, and created another sell climax. So selling below this 2 bar reversal is better to take for a swing short, since you're selling into the low of a trend channel. Prices could have easily rallied from here to the trend line, or at least the EMA. Good bear entry, good bear follow through. Bulls tried for a second entry here for the second sell climax, and bear trend channel overshoot could not trigger. Drifted mostly sideways into this small 3 push micro wedge bottom. This was a poor buy setup above the bear bar. It's the first entry since this sell off. No strong reversal bar, no really clear strong climax bar. However, this is a second climax. Consecutive climaxes increase the probability of a 2-leg correction. This was a small tight trading range final flag and second entry for this entry. So reasonable to buy above here, looking for 2 legs up. The bulls did not get good entry bar, not great follow through. However, they got follow through here, and they were able to create this breakout gap, and the gap was tested and left open. The market became always in long here, and some traders may say, you're buying in a strong bear trend. Are you crazy? Right? But what they don't understand is a climax. They don't understand. So traders that don't understand a climax think strong bear trend, and they think, okay, I want to wait and sell at the EMA or the bear trend line or whatever, right? And then the prices get above the EMA and they start selling over in here, and then prices rally, and they don't understand why. They think, that prices have been selling off all morning, and now all of a sudden you can't make a profit on any shorts. Why? And the reason is because there was a climax. There's 2 consecutive climaxes here. This was the first. Here's the second down. Consecutive climaxes increased the probability significantly of a 2-leg correction and possibly reversal. This was the first bull target above the second climax, which was reached here, temporarily sold off, and then prices rallied to the top of the first sell climax here, which is where a large trading range formed. So selling in here is a low probability thing to do. The bears are no longer willing to sell. The bears have taken profits. The strong bulls bought, the strong bears bought. So now prices are likely to make a 2-legged rally, at least a correction. So here was a breakout pullback high 1 buy setup, not a great signal bar. You're buying into the high of this bull leg. Prices were likely to come back and at least try to fill this bull gap. Bulls tried for a high 2 buy setup here above the bull bar, and then bears tried for a failed high 2 and a low 2 in an outside bear bar. Sorry, I got cut off. So anybody who sold below this bar got trapped and was forced out. This was a a better looking high 2 buy setup. It's a breakout pullback. You're expecting a second leg up from here. So high enough probability to scalp. However, better to take as a swing trade, but it is high enough probability to take for a scalp. And you can see there weren't a lot of great entries today. Strong trend days tend to be that way. Most entries tend to be swing entries. So it's not necessarily uncommon, and it really depends on your style of trading. If you're a really aggressive trader, you may see and take many more entries in here, but I try to only take best entries, which are these types of setups. So the bulls broke the trend line over here and formed this bull channel, and since prices have gone sideways in a large trading range, in a very tight trading range, I wanted to say, so yesterday I had some questions on targets, and there were two that I forgot to mention. Well, a couple I forgot to mention. So closes are targets, right? So bull and bear closes, especially strong bull bars, strong bear bars, tend to be targets. Climax, whenever there's a climax, a target, the first target is above the climax. So whether it's a first or second climax, rarely there's a third climax, but that's very rare. But the first target is above the climax, and that's because at the start of the climax is where the bears were willing to. So here's the second climax. The bears were willing to sell aggressively here on this sell-off. However, after the climax and they've taken profits, bulls are strong enough, the bears are not willing to sell until prices get somewhere near the start of the climax, which is the place where they originally sold the first time. So that makes it a kind of like a vacuum where the bulls are able to rally prices to the top of the climax. So that makes it a target in a vacuum. Other magnets or targets are the EMA. The EMA, when prices are close to the EMA, it tends to act as a magnet and suck prices to it, and that's because like when prices are in a trend, like say here, bears will sell one tick or one pip below the EMA, and then the next test they'll wait for a close above the EMA, and then they sell, and the next time they'll wait for an EMA gap bar like here. So that's the EMA sequence. And one other thing. So yesterday I talked about this strong bull close being the thank you God price, and I thought it was pretty interesting. So on the FOMC announcement, prices rallied straight to that close, and look at what happened when prices tested the close. They went 2, maybe 3 pips farther and sold off in 2 legs. So that to me tells me that any bull who had bought there exited on this rally. However, prices did rally strongly above overnight and form this stronger bull channel, broad bull channel trading range. But eventually led to a strong sell-off overnight. I got some other questions here. I'll try to go through them real quick. I don't have a lot of time, but if I don't get through all of them, I'll try to get through some of them tomorrow, and if not, then tomorrow. If not tomorrow, then Monday. Okay, so question is, are the formation of the bars important to make decisions? They sometimes confuse you by doing the exact opposite as what the bar was doing at the moment. Do you pay attention to how the bar grows, or you just wait until the close? I know that sometimes Brooks exits quickly depending on the current bar with a small loss. Most of the time you can see bulls or bears at the last 10 seconds of each bar. That means the bar can go from a signal bar to the opposite. Yeah, personally, I wait for the bar to close, whether I'm in a trade. I tend to do the same thing as Al, and sometimes we'll exit with most of the time I exit with a small loss as the bar is forming. However, I am trying very hard to wait for the bar to close because, like he said, the bar can change in the last 10 seconds of the bar. So personally, and as far as an entry goes, definitely I wait for the bar to close. I do not enter unless I'm entering with a limit order. If I'm looking for a swing, I wait for the bar to close because, like you said, the bar can change in the last few 10 seconds or so of the bar. A strong looking signal bar can change into a strong bear follow through or bear trend bar. So yeah, I wait for the bar to close, and I'm trying my best to wait for the bar to close before I exit as well, because I often exit before the bar closes, and then I think, well, that was really stupid. I exited the worst price, and I could have gotten out break even or even with a profit. So next question: Do you think there are a certain time for targets to accomplish? What I mean is that if you enter in a position, it's very rare to see price going your way on the next bar. It usually takes a couple of bars to get started. Same occurs when you're trying to get short or long, and price, instead of going your way, forms a wedge. I guess that is why you use a 20 pip stop loss. I'm not sure what he's talking about with the wedge thing, but no, I don't consider time with targets. Like he said, it might take 2 bars to reach my profit target. It might take 20. It all just depends on the day, the volume, the price action. So no, I have no time restraints as far as how long it takes to reach my target. What he's asking is if price doesn't reach my target within 5 bars or so, am I going to exit? And no, I will not exit. As long as my premise remains valid, I will not exit. And no, I wouldn't say that's the reason I use a 20 pip stop loss. I use a 20 pip stop loss because I'm not overly concerned with the risk, and I don't. If you're too focused on risk and you use a tight stop, you're going to get stopped out a lot. And I tend to get stopped out. If I use a tight stop, I get stopped out, and the prices go exactly where I thought they were going to go. So I use a 20 pip stop just to avoid the spread stopping me out, since like you said, prices don't always go exactly where you expect immediately. Next question: what are your thoughts about closes in Brooks' trading room? You can see that Brooks has the 5, 15 hour, daily, weekly charts on his screen. He usually comments about bulls and bears will try to form a signal bar. In other cases, do you think that matters if they created a signal bar or not? Yeah, you don't have to pay attention to higher time frame charts. I don't trade off them, but I do throughout the day. I don't have them pulled up on. This is all I trade off of is a 5-minute chart, just like you're looking at now. But I do glance at, like, every hour when the bar closes, I'll just look at the 60-minute chart and just see. Like I said, I don't trade off of it. I don't necessarily use it to initiate or make any trade decisions. I just kind of, I guess for fun. I don't know. I always, like you said, when the bar closes, I just look to see how the bar closed. I look at the 240-minute chart a couple times a day. I look at the daily chart in the morning. On Fridays, I look at the weekly chart to look for support and resistance on the weekly chart. If you read my analysis that I used to post, I would often talk about the daily and weekly charts, especially on Fridays, the weekly chart, and a monthly chart at the end of the month. So yeah, I don't think that you need to focus on those, but I mean, it doesn't hurt to look and see, and say, the 60-minute chart's always in short. But as far as using it to trade, I think that you'll confuse yourself, because you're never going to find an entry that aligns with both charts. If you do, it's rare. So I don't think it matters if you focus on them or not. I just tend to look at them for, I guess, out of boredom. I don't know. I'm gonna have to restart. Okay, next question. Prior entries can mean also support and resistance. If you look at your left and see a sell-off that gave 20 pips usually comes back to the entry point and goes back down for another certain target. What are your thoughts from this support and resistance areas? Yeah, and that's because it's better of an example is better when a gap is filled. But okay, so anybody or any bulls that did not buy this first entry here, they wanted in at this price. So what they'll do is they'll place a limit order at the price at the entry price. So above this bull bar, they'll place a limit order, and then when prices get back, they get filled on that order. And if prices do not reach that price, then they have to chase the market and they have to buy higher. So that's what creates a gap and keeps the gap open. It's when these bulls who did not buy are disappointed that they did not enter. And now when prices come back to test, they are not getting filled on this limit order, so they are forced to buy higher, like over here. So, and like I said about the climax thing, right? So strong bears were willing to sell aggressively here above this bar or at this close, right? So when prices get back to that price, they're likely to do the same. They do it again, whether for a scalp or for, and that's what forms a double top. That's what forms like this double top bear flag. The bears were willing to sell it here aggressively, formed a sell off. When prices got back up there again, they sold again aggressively. So that's common. As far as trying to figure out how far it's going to go based on that, I don't think you can do that. However, just know that when prices get back to the area, you can expect there's a strong signal like this double top bear flag. Just take the entry. But yeah, original entry prices are do hold as support and resistance. And especially when gaps are kept open or tested. Next question: Price always has the same cycle: spike, channel, trading range. It's spike, then it goes into a channel until it reaches support and resistance, then it goes sideways into a trading range. The problem is that they are sometimes difficult to identify. A channel can be a couple of bars or it can be many bars. The same occurs with the trading range. Any advice? I agree. Trading is very subjective. What this trend, today we have a strong bear trend day and a broad bear channel. Tomorrow it might be a tight, really strong bull channel, like a bull micro channel. So yeah, I understand the difficulty, but I think it just takes experience. I guess the best thing to do is to try to identify, try to find the trend line as early as you can. So, like in here, there's a tight bear channel, and every time prices get back here, tends to sell off. As far as how to identify it, I think it just takes experience. There's not really an easy way of doing it, otherwise we'd all be rich, right? So no, I can't. There's not really any clear answer to that question. Basically, just be as objective as you can and try to follow the institutions as close as you can. Next question: what is the best buying or selling pressure that you identify on charts? There are many ways, such as big, small bars, number of bars, closes, etc. Difficult to decide sometimes. And he gives an example. Let's say that you start seeing big bull bars, but they reverse in the next bars. However, the next bars are small bear bars, but also they have follow through. And you keep seeing the same process: big bull bars and then small bear bars. Well, if I keep seeing big bull bars and small bear bars, then the bulls are likely in control, and the small bear bars are simply a bull flag pullback. But as far as the question is buying pressure and selling pressure, buying pressure can be consecutive bars, it can be closes of bars, It can be reverses of bars, like a bar. Okay, so see here we had 3 bear bars down, and then one bull bar. Even though these 3 bear bars closed on their lows, one bull bar reversed all 3 closes. That's strong buying pressure. Look in here overnight in this, like I said, there was a small bear channel in here. Bulls broke the trend line, strong buying pressure. But on the retest down, there was very little buying pressure and strong selling pressure. So when prices were unable to reverse up here, the bears were able to take control again, and it's better to look to sell than it is to buy. As far as identifying strong pressure, gaps are a sign of pressure. Strong closes on their highs, consecutive bars are strong buying pressure. Like this is strong buying pressure. Reversal of closes is strong pressure. Breaking a trend line is strong pressure. So, like I said, that too just goes back to experience. Basically, as you get better at identifying who's in control and identifying types of pressure, then the more likely you are to make money. And the last question is, can you explain with examples what Brooks means by saying the best the bears can get is sideways? So that depends on the day. So if there's very little buying pressure, like a day like today, this is a very good example here. So like I said, strong selling pressure on this retest of the low. Therefore, the bulls were unable to take control. And so here's a small sell climax. But look at what happened after the sell climax. Look at the difference between this sell climax and this sell climax. Here we had strong consecutive bull bars closing on their highs, right? Here we had bull bar, tail, bear bar, bull bar, strong bull bar closing on its high, and then immediately a bear bar. So the bulls are not getting consecutive bars. The bulls are not getting strong follow through. So in that case, the best the bulls are going to get is a trading range. But however, the trading range can be at the top of the climax. The trading range can be at the top of the channel. So it depends on the day. It depends on what's. It depends on a lot of different things. But as far as thinking, okay, the best the bulls can get is a trading range. Just look at the buying pressure, and if the bulls are not getting strong follow through or strong consecutive bars, then more than likely prices are going to enter a trading range, and that's because of the like he said earlier in the other question. That's because of the market cycle. Prices drift from a channel into a trading range and then reverse. Prices don't go from a bear channel to a bull channel. A V bottom is very rare except for a climax, right? So like here, prices were in a tight bear channel climax. Bulls got strong reversal up, but it only led to a trading range. It led to a big trading range here. So the trading range can be, like I said, at the top of the climax. It can be a small bear flag trading range like this, or it can be a large trading range at the start of the channel. Prices theoretically could have came all the way up here and formed a large trading range up here had the bulls generated enough strength. So I don't know if that answered the question, but you got to remember trading is very subjective. Trading is very hard to do. This is not an easy thing to do. It takes a lot of time and experience. So you just have to keep at it and just keep doing your best every day. But all right, I don't have any time to go over any more, but I'll see you guys later.